Right in and welcome to today's Monday morning mortgage update. So a little bit before I jump in, I'm actually going to talk a little bit about the tariffs real fast so you kind of know what's happening in the tariff market because we have some pretty interesting moves. As you know, our president is the author of what's the movie? The Art of the Deal, or the Art of something like that, right? The book. Um, Sometimes the stuff he does is a little over the top to get a solution, and it seems to have worked because what they are now proposing, instead of that 25% tariff, they are now coming together and doing an equal tit for tat type thing with the overall tariffs. Now, the United States for the last several decades has been paying very high tariffs on imports, but then charging very little on our exports. So it hasn't been, quote, fair. So now we're going to be with the different countries. If theirs is 1.25% tariff on our goods, and ours is 25 basis points on vice versa, they're going to meet in the middle and be equal. So there's going to be actual equal trade, and that's what's in the talks today. So I think that is the most amazing outcome of this that I don't think anyone was expecting. It's going to be good for absolutely everybody. So I don't know if you've seen, but there's some countries that have some cars that we don't because they tariff the heck out of them. We can never afford them. So they just don't even ship them. Like there's some cars in Japan and Toyota that I want that I would love to have, but because of tariffs and other things, it's impossible. So hopefully that'll help free trade up a lot, help the overall global economy. That's just something that I don't think anyone saw. And as I share with you coming up right here, I'm going to share you, well, if I can figure out how to share my screen now, there we go. I'm going to share what the stock market is doing today because it's crazy. But before that, I'm going to go into what's happening this April. So the Fed spoke last week, and I'm going to get to the stocks in a few seconds. But the Fed spoke last week, and they went over kind of what's going to be happening with the jobs numbers, with everything that is going on, with inflation. And they were more afraid of inflation than they were the jobs numbers. So that was interesting. So we'll talk about that in a second. But then I talked about the balance sheet. And we said to really listen for the Feds talking about what they're going to be doing with the balance sheet. You might be asking, what is the balance sheet? Well, the balance sheet is basically their asset sheet, what they own on assets and debt and everything, right? Or what they kind of have in their hands. Well,
You can drop it
you
to
remember, if you remember back
will
to
deliver it.
here, make sure you guys are muting, so just in case.
Sorry.
But they were buying mortgage-backed securities at the tune of 60 to 80 billion a month during COVID. That drove interest rates down. So when you are looking for lower rates, if the Fed buys a bunch of mortgage-backed securities, that is going to absolutely drive interest rates down. So what they were doing during COVID, they were buying, driving interest rates down, and then they stopped, and that's when kind of rates flattened out. And then they started selling off their balance sheet. So they owned a lot of mortgage-backed securities, and then they started selling them off. And they've been selling them off for quite some time. And they just announced, and okay, if you buy them, it drives rates down. If you sell them, it drives rates up, right? So they announced starting April, which is what, 7 days away, 6 days away, they are going to start buying mortgage-backed securities. So let me tell you what that looks like in more detail. So if you look at where we're at, they're going to be, instead of selling off 25 billion, they're selling off 5 billion. So essentially they're going to reinvest that extra 20 billion in buying mortgage-backed securities. So super excited. That is a very, very big deal. Hopefully that'll put pressure on mortgage rates to come down. We will see. But because they were buying so many more before, and that's what drove rates down, we're going to see what type of an impact this has because they haven't done this for a while. The Fed also mentioned in their meeting that the unemployment rate has stabilized. They think it has stabilized, I don't think it has, but that's my opinion. We'll go over those numbers in just a second. And then Waller is one of the Fed presidents, and he dissented. He didn't want the balance sheet reduction. He didn't think we should be doing that. So there's some people in the Federal Reserve that don't agree with each other, which is typical. But let's kind of see where we're at with their summary of economic projections, which they outlined in their meeting. So the unemployment, they in December of 18th was 4.3, and now and as of March 19th, it was at 4.4. The GDP, December 18th was expected at 2.1. Now we're at 1.7, so that's weaker. The core PCE is actually a little hotter. That's a personal consumption expenditure. That's the inflation numbers. December of 18 was 2.5, and it's actually 2.8. And they're still expecting 2 cuts this year. So the GDP is less, which means slower growth. The unemployment rate is a little higher than what there was in December, but inflation is still a little high. And I don't know if you remember this, we had some pretty high numbers that we're going to be replacing with the current numbers. So we're going to see the inflation numbers be stubborn through the summer. So don't expect inflation numbers to come down. It's just because we're replacing one of the 12 monthly inflation numbers and taking away one and replacing with a new one and re-averaging. So the ones we're replacing are really low. We're going to replacing those with a good one, but it's going to make the average overall go up. So here's the dot plot. These are the members of the Feds and what they and how many are voting and how many are telling us that they're going to be voting for rate cuts. So in December, one member didn't want any cuts. 3 members wanted 1 cut. 10 members wanted 2 cuts. And then 5 members wanted 3+ cuts. That was their dot plot for the future moving forward for the year 2025. Now we have 4 wanting 0 cuts. Notice that's gone up a lot. 4 only wanting 1 cut. That's gone up 1. 9 wanting 2 cuts. That's gone down 1. And only 2 members want 3 or more cuts. So the Feds are changing their tune a little bit. They're being a little bit more conservative on how many cuts for this year. So that's interesting to watch. But it all comes down to employment. And I think this is the thing that's going to surprise some of the Fed members. And at least that's what I'm thinking. And here's why. So right now, I don't know if you guys know this, but there's 2 models that give you an unemployment report. The Fed uses the U3 model. The U3 model is what is cited all the time. So when they say our unemployment rate is 4.1%, what that means is those people that have lost their jobs and are currently actively looking for new jobs no longer than 4 weeks after their unemployment started, those people, there's 4.1% unemployment. But once it goes past 4 weeks and they haven't gotten a job, they drop off this number. They just don't count them anymore. I don't know why. Because some people it takes 6, 7, 8 weeks, maybe 3 or 4 months to find a job. They just don't count them anymore. If you use the U6 model, which adds those back in, we're actually at an 8% unemployment level. And that's the highest since 2021. So I think we're going to have a couple of the Fed chairs be a little surprised because they don't really know all of the data. Their attorneys, most of them, they have their own business. It's just, I don't trust them. That's just what I'm saying. So I think we're going to see a little bit of surprises. And here's where it's interesting. Now, this chart is kind of hard to understand when you're looking at it. The March projections for the unemployment numbers are in the 4.0. There's 6 people that think it's going to be between 4.2 and 4.3. There's 11 Fed chair that think the unemployment is going to be 4.4 to 4.5, and only one thinks the unemployment rate is going to go to 4.6 to 4.7. Now, if this goes up and it surprises, let's just say this hits 4.7, that means it surprised every single Fed chair except for one, this guy right here. Now, if the U6 is at 8, I wouldn't be surprised if we had unemployment numbers in the 4.6 to 4.7 moving forward. But I just think that how they report it is kind of silly. But that's in itself something we can talk about at a later date. But some good news, some really, really good news is existing home sales actually went up month over month by 4.2%. So that was much hotter than expected. They actually thought it was going to go down 3%. And excuse me, that made the overall year over year down 1.2% compared to the same numbers for the previous year. So not terrible, not good, because last year was not the best in the world, but we're not falling off the map. It's still it's actually pretty steady. Median home price went up 1.3% month over month. That's not bad. Up 3.8% year over year. Not bad. So these are pretty decent numbers. If you look at the inventory, we're up 5.1 month over month, up 17% year over year. That's a good thing. We need the inventory, but we need better inventory. We need these people that are selling their homes to upgrade them before they come to us, right? Come to you or fix them, make them better. There is 3.5 months supply. A normal market is 4.6. So we're still below. But if you add in the inventory, that's just not the best. We still have a pretty short supply of really, really good homes. So 42 days on market, up a little bit from last year, which was 38. Here's some interesting information. Sold above list, 21%. 20% last year. We're at 21% now. First-time home buyers is up 5% compared to last year. We're at 31%, and now last year was 26%. Cash buyers is about the same. It's 32% compared to last year of 33%. And investors are down 5%, 16% compared to 21%. So I thought that was really interesting. Now these are the rates predicted. I don't think there's going to be a huge move, but we'll see what this April surprise is with them buying mortgage-backed securities. We'll see if these predictions change. But notice it's not much different. Maybe a quarter to a half in rate overall we're going to see drop. Isn't a lot, but it's going to help. So we're excited about that. So back to the stock market and those tariffs and the change of that. What did that do to the markets? Check this out. So in the past, just today, we're up 500 points on the Dow. Over the past 5 days, we're up 741 points. So the markets globally really, really like the new equal tariff rule that is being proposed. So again, if China is tariffing our stuff 1.25%, and we're only doing 25%, the agreement is meet in the middle at maybe 70 basis points for both. Interesting, right? And it's going to go across that for the top 20 economies globally. So it's going to be interesting to see how that comes through. The market seemed to really, really love that. It kind of took some of the fear of that 25 basis point just across the board out of the equation. And now you're seeing the markets rally again. So very, very good information there. So now you'll see as we look at the mortgage rates, today there's actually no activity going on other than normal trading. And I actually like these days because it shows actually what happens on a typical day when people move money from a secure location into the stock market. So what you've seen is a little bit of a bond sell-off. So you saw bonds sell off and they moved it into stock. So we saw today the Fannie Mae bond lose about 14 basis points so far, and we're stuck right on this Fibonacci level. So rates got a little bit worse today because people are taking their gains and they're moving their money from the bond market to the stock market. So we see the stock market go up and bond market go down. That's traditionally how things work. So it's usually easy to see. And we stuck right on this Fibonacci level. It's amazing how that works. And we also have the 25-day moving average right beneath that. So we've got a nice floor of support. We should get a rebound off this because there's some heavy trading in the stock market today. There may be some people that are going to take some gains tomorrow, and we may see a little bit of reversal in the stock market, but we'll see. We'll see if we hold here. Hopefully we do, so we can see rates get better as we go through the week, and we'll look at what's happening the rest of the week economy-wise on the calendar just coming up. Here's the 10-year. We saw a big bounce. Look at that. So on the 200-day moving average, we tried to go beneath it last week, and we failed. So this was going to be good because remember, when the 10-year goes down, rates go down. We saw it go all the way down here and then bounce back up and right above that. And the next day on Friday, the same thing. It tried to go down and then it ended up above. And then today we went all the way up to the 25-day moving average and on this Fibonacci level. So another ceiling of support. So we're going to float right now to see what this does for the rest of the week and see what rates do. Here's kind of where rates are at right now. 30-year fixed in the 6.8 range. On a conventional, FHA is a little bit better. Most FHA has bad credit scores. That's why people use that. So sometimes the rates are a little bit higher, but this is remember, these are the creme de la creme of scenarios here. But as you can see, they're negatively for the day, the Monday's rate trend. But this is good in the sixes. That makes people happy. In their sevens, it doesn't make people happy. There's some jumbo averaging in the sevens right now. We do actually have quite a few jumbos in the mid sixes right now. So that's a good thing. So mortgage rates overall aren't bad. Hopefully they'll get a little bit better. And here's what's going on this week. Again, nothing happening today other than normal trading. That's why we see people, they're moving into stocks and then they're taking it out of bonds. And that's why we're seeing that a normal reaction there, which is kind of nice to see. On Tuesday, we have a 2-year treasury auction. Not much really coming in. We have consumer confidence, consumer price, the Case-Shiller home price indices. This is going to be interesting to see. The Richmond Fed, the manufacturing index, that could give us some light on maybe a weaker economy there on manufacturing. We have durable goods orders and exports and transportation coming out in a 5-year auction on Wednesday. So not a ton of stuff. And then GDP Thursday. That's going to be interesting to see. If you want to do a deep dive into GDP, I may do a class on that because, sorry, I've got this line of light come through here. Because there's a lot of gold movement happening that's going to affect GDP overall, that the GDP could look less than it is because of that. So we can get into that later on. So if you have questions on that. We have jobless claims. And then on Friday, PCE, we have the good old inflation numbers. So I don't expect this to be great for us. I think it's going to be mediocre. I think it's going to be as expected. If we get a surprise, that would be great. So that's what's going on right now. And good day in the stocks. So if you guys were mad that you lost a bunch this last couple weeks, looks like we're rallying that back. So that's a good thing. So other than that, you guys know we've got our pre-approval guarantee. If our buyers get us everything we need, hint, hint, push, push, get those buyers to get our stuff in together, then we can guarantee the pre-approval with a $5,000 guarantee to the seller that our buyers will perform. And again, we're licensed in every state except for New York and Hawaii. So any questions out there on what's happening with the markets and what I can do to help you prepare for the week? Any questions? Are they counting all the federal workers being laid off? That is going to be part of it. The numbers that we saw in the unemployment for the previous month. So as those numbers come out, they will be counting those. So great question. For unemployment, yes, they will be counting those. So those will be part of it. It's interesting, if you looked at all of the growth that we had over the last 12 months for employment, all of those new job growths that were coming out when they said, jobs are hotter than expected, 95% of those jobs were government-related jobs. So when your government is outpacing the private sector at more than 95%, that's not balanced. So that's one of the reasons that there's cuts right now, trying to get that back in line. But that's not a great balanced economy. Hopefully we can get the private sector to start roaring their motors again, and it could go 95 private sector and 5% government. That would be phenomenal. That would mean a great economy. So we'll see what that looks like. That was in the Q&A. Any other questions? Let's see if I'm going to open up the chat real fast. I'm curious about this shopping spree now. So the shopping spree, yeah, they're going to be buying 20 billion in mortgage-backed securities starting April 1st. Hopefully that's not an April Fool's joke, but hopefully. But is there a key upcoming date we should watch for potential rate cuts? Just keep an eye on the Fed. The rate cuts, remember, they don't do much for mortgage. In fact, the last 3 rate cuts, mortgage rates went up, and here's why. The mortgage, when you cut the Fed funds rate, you stimulate the economy. Stimulation of the economy means more spending. More spending and more money means potential more inflation. More inflation is scary for long-term interest rates. So rate cuts at the Federal Reserve is not a mortgage rate cut. It is a short-term cut to money that is being borrowed overnight. So it affects short-term money like your credit cards, home equity lines that are tied to the prime rate. But long-term, it could be inflationary. So when they cut the Fed funds rate, it actually could make mortgage rates go up like it has the last 3 times. So just keep your eye on the Feds and keep watching my meetings, and you should be fine to know exactly what's going to be happening. Hopefully, it'll be some good news on the inflation point at the end of the week. The GDP, I think, is going to be weaker than expected, so we'll keep an eye on that. But any mortgage-related questions on programs, keep in mind, we have that really good doctor loan. I need to get a little video out to you guys on that. Because it is a fantastic new doctor program. And it's not just for doctors, it's for veterinarians. It's for anyone that has a doctorate. So you could be a poet with a doctorate in English, and you are a doctor. So it's kind of silly, but hey, it works. So it doesn't have to be just a medical doctor. So just keep that in mind. Any questions as we move forward? All right. Well, enjoy your week and enjoy this last week of March. Now we're in spring, and we will talk to everyone very soon. You guys have a great day.
Bye, everyone.